When we're sending in a package to a funding source, let's talk a little bit about the purpose of sending this in. We want to talk about the elements of the lease package that we're sending through. We want to talk about the detailed questions that lead to a narrative to one of these because we don't want to write a book, but we do want to tell a story. And when we're doing a larger transaction versus a mini lease, we're going to have to give a little bit of a write-up or narrative, if you will, to the funding source. The best way I can explain this narrative to you is to think about if you owned a company and you need to go out and acquire a couple of pieces of equipment for $100,000 each to go into your manufacturing floor because your business is picking up and you have all these additional orders. So you're walking into a bank with your financial statements and your tax returns, and now you're going to sit down to the bank and say, Mr. Banker, I've been in business for this number of years, and here's what's going on. And you're going to start talking to the banker, telling your story. Well, that's what this narrative does. This is us taking the information from the lessee, putting it into a very succinct, comprehensive story, which is our narrative, and submitting that to the funding source so they understand what we're trying to do. And then we're going to support that with our different financial instruments, like our tax returns and financial statements and credit bureaus and bank investigations and that sort of thing. Then we're going to come up to a conclusion and write up the conclusion to the funding source of exactly what we want to do. Now, in leasing, you're going to find that there are primarily three basic sales that we have to deal with. Number one, we have sold the vendor on putting a program in there to help them increase their sales. And we've talked about this at length in the previous series. Number two, after the vendor sends us a transaction, we have to close this up with the lessee. Get the lessee very comfortable with it, go in and turn around and get the transaction, having a proposal issued and getting a check, getting this transaction off the street. So sale one's to the vendor, sale two is to the end user, the lessee, and then sale three, and a lot of folks will tell you, and I totally concur, that this is really the most important of the three, and that's selling this transaction to the credit authority. Whether it be an internal credit manager to an external funding source, because if you can't get the transactions approved, all of the work you've done to turn around and set up the program with the vendor and all the work you've done to set the thing in motion with the lessee and get control of the transaction, all that's for naught if you can't get the transaction approved. So again, that is why it is very important that you use a rifle and not a shotgun, and you're out there trying to get the business that your funding source is going to like in the first place. And number two, it's another reason why you want to control these transactions, and that's why it's very important that you understand exactly what the criteria is for your funding sources. And that way we can make the sale number three and bring this transaction to a conclusion. Okay, we've talked about our three sales to the vendor, the lessee, and the credit authorities, so let's kind of give you a financial package checklist. First of all the things that you need to be sure you have. It's important that you put these things in an order, as they don't necessarily have to be in this order. You can set it up on your own, but you should probably submit them in the same way each time. Remember, again, you want to use the philosophy a little bit with the credit managers. If you put in a nice, neat, concise package, you're going to find that you're going to get answers faster and you're going to get them easier. So number one, we need to have on every transaction, whether it be a mini lease or a package, we need to have a good, complete credit application. All of your pertinent information on the company, the legal name of the company, how long they've been in business, the type of entity they are, how long they've been around, who the principals are, where the equipment's going to be located, and all of that needs to be complete. So just because you have a big transaction for a big company with a lot of financial data supplied, you still need a good credit application. Next, we need to have those financial statements. They should be in order by year. Then we need to have the corresponding tax returns. We're going to need the interim financials, and we're going to need the personal financial information on the principals. One of the things that is very, very important that you may do in a package, and this may sound like an obvious thing to do, but it's one of the things that a lot of folks forget to put into, is the equipment justification to the lessee. If they're buying a piece of equipment, you need to tell the funding source why they're buying it. Is this an additional piece of equipment? And if it is, why are they buying an additional piece? Is it because their sales are up, because they need a higher production capabilities? If you think about that, that turns around and shows that a company is growing and there's a good reason for them to buy this equipment to essentially be adding additional debt. This may turn around and be a piece of equipment that is going to be replaced. That means it's going to be more efficient, which means their expenses are going to be less, that type of thing. Again, if they were adding an additional piece of equipment, maybe it's because they've been outsourcing what this piece of equipment is going to do. In many cases, this new piece of equipment may be costing them nothing and in fact saving them money because they're getting in a piece of equipment that may cost them a couple $1,000s a month, but at the same time it's eliminating $5,000 a month in expenses. You need to look at this justification. Be sure that it's there, because if you have a CPA, for example, that wants to lease a forklift, you better start asking some questions, because that doesn't make any sense. Now, we need a good description of the equipment. In some situations, that's going to be very obvious, but in most cases, it's not. So have a good description of the equipment. Remember, one of the things that you want to break out here in this equipment is the soft costs, if they're involved, because the funding source is going to ask you that. This is a good place, if you remember, we talked about when we were putting our vendor programs together, to get brochures from the vendors. Funding sources and credit managers love color pictures, so this is where you could also include a brochure on the equipment if it's anything that's unique at all. Again, we want to talk here about exactly what the cost is going to be in total and how much money that we're requesting. We want to give the information on the vendor. Now, we discussed this before, but it certainly justifies talking about it here. Fraud is the largest cause of losses in our industry, and we're going to be covering fraud in a separate section by itself. But a part of your credit approval, and remember, this is just because it's important. It's not just because getting your lessee approved because of all of this financial information. You need to have the vendor approved as well. So this is where you would include your vendor profile and the information on your vendor to show that they're not going to have problems after they get this equipment, and that there's not a vendor around to take care of it or service it, or that everything on this transaction was done on the up and up. The other thing to be sure to point out is the delivery location, where the equipment is going to be located. Again, can be a definite effect on where the taxes are. It also tells them where they need to do their UCC filings. In other words, to show them that the equipment belongs to them, protect their interest in the ownership of the equipment. We need to let them know what the delivery date is going to be, and we also need to let them know not only the delivery date, but where the acceptance date is going to be. Remember, in most cases, your approvals are only good for 90 days. So if you're going to have a transaction that you're sending in and being approved now, but that the equipment's going to be 4 or 5 months before it comes in, you're going to need to make special provisions with your funding source now when you get that transaction approved. So you may have to do something like an addendum to your proposal or to the lease that has a payment adjustment in it tied to some kind of index, whether it be T-bills, prime, or something like that, in case your pricing was to change between the time that you have it approved or when the equipment is accepted. Remember, there may be a major difference here between the date of delivery and the date of acceptance, because in some cases the equipment could be delivered in a couple, 3 weeks, but the installation time, because of training and other things may go with it, may be several months before it's actually put in. We need to send a submission sheet. Now, the things we've talked about are the things that we're going to need to address. The first thing that you want to do in a package transaction is put together a submission sheet. This is like the old Dragnet thing or the Detective Friday or whatever. That's just the facts, ma'am, just the facts. So we want to just very succinctly put on the top of this package a sheet that says this is today's date. This thing is going to ABC Funding Source. It is from you, your leasing company, and you would not believe how many times leasing companies, funding sources, receive a package that comes in Federal Express or whatever, pulled out by a person there at the funding source, big rubber bands put around it, and it's sent on a credit manager's desk. The credit manager is looking through this transaction, but has no idea who submitted it. They can actually be ready to approve it, and then they don't know who to call or approve it. The amount of the lease should be on this cover sheet. Who the lessee will be on it, the equipment location, who the guarantors are, if any, what the equipment is, who the vendor is, the cost breakdown, how many advance rentals or security deposits that we're getting on this transaction, and what the purchase option are that's been quoted to the lessee. any additional collateral, if we have that, what the anticipated delivery date is, what the anticipated acceptance date is, how long the lease is going to be for. Now, these are the things that just on a front sheet that are given the very simple facts of the transaction. It's a summary. If you think about with a credit manager, he's getting ready to look at a package. What's one of the first things that they want to know? What the equipment cost is. Is this transaction for $100,000? Is it for $2 million? Because they're going to look at it differently depending upon the size of it. So you don't want them to have to start digging into this package to find out this pertinent information of who it's from, how long it's for, how much it's for, what the equipment is. Just put all these things in a very simple cover sheet. Bang, 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 and lay it out all the facts of the transaction in front of them so that they even get into the package. The very first sheet tells them exactly what they're about to look at.
What you're trying to do is do the credit manager's job for them. So all they have to do is go in and verify the information that you've given them. There's a few things that are very important on a package transaction to address, and unless you have an absolute slam dunk credit, it's not normally the case, you're going to want to get this information. You're going to want to talk about the background of the company, where they started, where they've gone, why they've been successful. Many times there are some things that can be important in this discussion to talk about. It's the management and the background of the people that run the company. Again, we have the equipment justification, or why the lessee is acquiring this equipment. We spoke about this earlier in a different section, but one of the things that I would suggest that you do is, before you go any further, is to do the cash flow calculation and put that towards the very front of your package so that you're starting out in the credit manager's mind that the deal cash flows. Remember, the most important criteria in a credit decision is to show that they have the ability to make the payment. So if you show that there's a positive cash flow from the get-go, you got a credit manager looking at this transaction in a very positive light from the very beginning. So again, to run down that cash flow calculation for you, we want to take our net profits after taxes off the financial statement. Add to that number the depreciation to give us our gross cash flow. Subtract from that the current maturities of their long-term debt. Figure out what your payments on this lease are going to be, and take 12 of those payments and subtract it, and that should tell us if you have the adequate cash flow. Then, of course, after you have that cash flow number, you can add or subtract any extraordinary income or expense items. The next thing that we want to do is we want to deal with the balance sheet. Now, in the accounting or financial statements section, we did talk about a balance sheet, but I want to let you know a few places that you can look for on this balance sheet to help you shore up a transaction or make it look like a good thing to the funding source. One is to take a good look at those accounts receivables. This number should be a relatively large number. We want to see what the accounts receivables are. You want to see what kind of adjustments they have in there for charge-offs, looking at the previous years, and we talked about trend analysis. And one of the reasons we need 2 and 3 and 4 years financials is because we want to see if they collect the receivables that they have. Also, pay attention to who those receivables are to, because sometimes you can see receivables that may be from an affiliate company, another company that they own, or a receivable from the stockholders or things like that. So you want to find out if these numbers are real and if those numbers are large. One of the things that I will say to you about financials that a lot of people are intimidated by financial statements. You know, they look at the big numbers and, you know, it all ties together. For example, a $4,000 or a $5,000 number on a $2 million company just doesn't make much difference. If the big numbers will make sense, the small ones will fall in line. I know that might sound overly simplified, but trust me, it'll work. Now you want to take a look at their inventory and see if they're turning their inventory in appropriate periods of time and things like that. to see if their inventory is large or small compared to what it should be. And again, you can go into RMA, Robert Marsh and Associates, and look at what the industry standards are. Your property, plant, and equipment, we mentioned this earlier, this can be a large spot to look for. It's a very good spot to look for hidden assets of a company. Remember, their plant and equipment were primarily put on their balance sheet by cost, and so the equipment and the plant inventory, things like that, could be much greater in value than what's actually showing on their financial statements. So you want to be sure to take a look. Their long-term debt is something you should pay close attention to because that's what's going to be expiring, and that could have a definite effect on cash flow. And then, of course, look at their net worth, which certainly can help, and there's never enough net worth in the mind of a funding source. So be sure to take a look at that. Now we come to the income statement. This, remember, shows the productivity of a company and how they're doing. We want to see that these sales numbers hopefully have been increasing on a regular basis. We want to show that the cost of goods have been constant and not getting out of line with sales, and that their percentages aren't getting out of whack. And this is one of the reasons that we gave you those formulas under financial statements so that you can do things like gross margin and things like that. Look at the large expenses, see if they're out of whack, see if they're making sense. A lot of times you're going to find that this equipment request is designed to reduce some of those large expenses. You have to remember, even though this might sound overly simplified, there are two ways that a company can turn around and increase their bottom line. One is to increase revenue. The other is to reduce expenses, or a combination of the two. In many cases, this equipment is not going in because sales are greater. It's going in to reduce expenses. They're getting upgraded equipment to be more efficient, to save man hours, because you have to remember that with virtually every company, the greatest expense that they have is their people cost. And if they can get machinery and do it more efficient and automated, then they can turn around and save money. So in a lot of cases, it's not an additional expense that they're bringing on with this equipment. It's reducing expenses that they already have. We want to be sure that we look at these extraordinary income and expense items that may or may not be on their income statement. If we see a number that's way out of whack from where the other 2 years were, why did this particular expense exist? Or why did this particular income exist? If we see a big hunk come in on a company that this company's done $500,000 of sales, and every year, all of a sudden, boom, they had $1.5 million, and then the next year it went down $500,000 or something like that, we want to look and find out, have a contact and see what's going on, what brought the money in, and was it a one-shot deal that's not going to be reoccurring. Or it could be that they sold off some equipment or a building or something like that and brought in a lot of income, which makes the numbers look good today. But again, that's a one-time thing. Conversely, it can be the same thing with an expense. We could show numbers that don't look very favorable in a particular year, but they may have lost a lawsuit. They might have gotten hit with a big tax lien. They might have had a large charge-off on receivables where one of the companies that owed them money went bankrupt or something like that. So pay very close attention to that. You want to look at their net incomes. And again, be sure you look at the dividends and the distribution. It could be because these numbers don't look real favorable. It's because the principals have taken a lot of money out of the company. But if we have the personal guarantee of the principal and we're looking at their personal financial statements, then the transaction still may look good, very substantial, and you won't have a problem. Also, look at their depreciation to see if those numbers are high or low. This could indicate that they're taking a lot of equipment, or it could be to show that they're paying off a lot of equipment. And you can kind of see from the depreciation what's going on. Again, and I can't emphasize this enough, even though you have to wade through these sometimes, take the time to read the notes that accompany the financial statement, because this is where all your subsequent events and your liabilities may be, as well as operating leases. Because if there's a problem out there, we need to know it. If there's a litigation or something like that, and the funding source is going to notice it. Of course, along with our financial information that we're giving them here, we want to be sure that we're giving them good bank references and that we have established all of the banking relationships and our trade references. And then what we want to do in our narrative is give them a summary of the positive and the negatives and make our recommendation. What we do in the narrative is summarize all of our key points, address all of the basics of the financial package, our financial statements, tax returns, personal financials, all that. And this is another area that is something you want to watch out for, because a lot of people, when they're submitting a transaction, if they're negatives, if there have been problems or there's problems that exist now with the company, the smartest thing that you can do is point them out. Point them out in great, big, huge, bold letters and underline them and show them to the funding source. Because I guarantee you this, they're going to find them. They're trained to look for the negatives. So don't try to hide them. The best thing you can do with a negative is to point it out and say, here's the negative, here's why it happens, here's how it was resolved, and here's why it won't happen again. If you can't justify that negative and there's a cause for a turn down, you shouldn't even be submitting the transaction in the first place. Don't think that you're going to hide or bury a negative, because it's not going to happen, and all you're going to do is get a bad reputation with that funding source. So point out the negatives. Credit people are going to find them, and also be very positive that you point out the positives. They will miss the positives. They're not looking for the positives, they're looking for the negatives. Funding sources tend to go in and look for the reasons that are wrong with the transaction. And in lieu of those, they'll approve it. But they can miss positives, so be sure that you point those out. Then, of course, after you've done that, summarize your transaction, give it to them with your recommendation. The bottom line in this packaging is that you want to do the credit manager's job for them. Put these in a nice, succinct, neat little package. I would suggest that in a lot of cases you bind these things up, if they're substantial. And if you don't have the equipment and you don't have a lot of these things, you can run down to Kinko's or have somebody, do them up for you. But when you do bind them, pay special attention that you bind them correctly. Number one, don't put them where the seams are closed and you open it up and, they can't see the numbers. Be sure that when you're making copies of all these things that you leave enough margin on the left-hand side and you're not putting holes in the numbers, things like that. So present that package in a very neat and organized manner, because it will tend to get moved to the top of the pile. If you send in a sloppy package and basically take a brown bag and dump this on the credit manager's desk, he's going to do a lot of rummaging through it and sorting through it, and he'll say, I don't have time to look at this. This is a mess. So, the deal may take longer to get decisioned. If they know that when your packages come in that they're clean, concise, and the work's been prepared for them, you'll spread all the financials. You have done the tax returns and the cash flows and all that's right in front of them, then they will tend to go and just grab yours, because they can probably make a decision on it in 5 or 10 minutes. Again, the best test for these package transactions before you send them in is to simply say, if this was my $250,000 and I was going to invest in this lease, would I do it? That's the best benchmark that I can give you for going through these transactions. So take the time, do your research, get all the information, put it together in a very clean and concise manner. Even though these may be substantial in bulk, the idea here is not to write a book, especially with your narrative. Just be very concise about what you have, point out your negatives, point out your positives, make your recommendation, and take a nice clean package, submit it to the funding source, and I think you'll find that the approval percentages that you get will be substantially higher since you put these packages together correctly. Let me summarize a little bit what we need to do when we're presenting a package transaction to a funding source. One, we need to have the submission sheet on top that says that this is such and such funding source and it's from you and today's date and the amount of the lease and who the lessee is and where the equipment location is going to be and who the guarantor is, and what the equipment is and who the vendor is. We want to put our cost breakdowns, our advance rentals, our security deposit, our purchase options, any additional collateral that we have. And when we think it'll be delivered and when we think they're going to accept it. You want to include, along with the front sheet, a little bit about the background of the company. Put in there the management and the people that are running the operation, and show good equipment justification and tell why the lessee is acquiring the equipment. We've given them the facts, we've given them the basic background on this thing, and then the next thing, of course, is to be sure that you do the cash flow calculation to show that this debt service, how it's going to flow, and you go through your balance sheet, point out any items that are there that are good, bad, and that help shore up the transaction. Review the income statement, point out issues there that can help you. Be sure that you have all your banks and your trade references and that you've got your summary there of your positives and negatives, and you've taken the time, you've pointed out the negatives, and here's why they existed. Here's how it was fixed, and here's why it won't reoccur. And don't forget to point out those positives because they look for the negatives and can miss the positives, and then make your recommendation. Summarize all your key points, point out the positives and negatives, put the transaction together for them so you're doing the credit manager's job for them, present the package in a neat and organized manner. If you do this each time, you're going to have a much higher closing and a much higher funding to submission rate with your funding sources. This makes them like you. They get used to seeing your packages, being done correctly. And, just from a psychology standpoint, it's going to help you get more transactions approved. And that's the goal.